Welcome, Dave. This is a pleasure to have you with us today. I think what you've done is quite interesting, quite fascinating for traders like us, because you have made a tool which I haven't found anything comparable to this in on the whole trading scene, which means that you made a tool where you can actually test your strategies without coding, and I think that's really fascinating. So we've been looking a long time for a tool like this, and finally we found your tool. So I'm very happy to be working with you and presenting this webinar tonight. So yeah, we are very interested to know how you work with strategies, what is important to you, and also how your tool works and how you can actually test strategies without programming. So I think I have to give the screen over to you. So I think I'm just going to do that, and then you can take the screen, and then I'm going to close my webcam so we will focus on you. Thank you very much, Dave.
All right. Okay, there we go. All right, so thanks for joining, everyone. I have to start with some disclaimers just because of some positions I'm in. But anyways, futures and Forex trading contains substantial risk. It's not for every investor. I'm sure you guys have heard this a million times, but basically you should only use risk capital, and that's capital that doesn't change your lifestyle or financial situation if you were to lose it. And obviously past performance is not indicative of future success. And any results are shown or will show, or any tests we run, just assume it's hypothetical. And obviously, do your own testing and due diligence before you put anything into practice. I think that should cover us. So let me see. Oh, it keeps pulling me out of. Okay, you guys see the next slide? I'll assume yes. Somebody just stop me if not. Okay, great.
Yeah, we can see it.
Awesome. So who am I? Important, I guess. I started with professional trading almost 10 years ago. I think I'm a month or two shy at this point. Mostly we did high frequency trading, market making, and some options, primarily in the US futures market. So the S&P 500 futures, the E-mini, and also across the Treasury complex, mostly the 10-year note. So again, some of the most liquid and competitive markets there are. And I've been trading in some capacity for nearly 15 years. The first 5 years were probably a little more exciting, and we'll start there because I think that really builds and breaks down and then rebuilds the foundation of how I view trading today. I also consult for some hedge funds, family offices, and registered investment advisors, typically with AUM, assets under management, over 100 million, just because that presents a couple new challenges, capacity, audits, things like that, that require some expertise. And also, I'm typically referred to as a quantitative trader. It's not a term that I dislike, but I do think the better term is a data trader, just because if you think of the opposite of that, a no data trader, right? Nobody wants to be that. So I think by calling it a data trader, I hope to open, more people up to this approach to trading, the quantitative approach as opposed to, the standard technical or fundamental. And we'll get into all that. So if you want to know more about me, I've been featured on some other podcasts, Chat with Traders, Better System Trader, and then I've crossed some various other, trading sources like TradeStation, IB, MarketWatch, Quantocracy. So if you look for it, I'm out there. You can find it. So why trading, right? I mean, the same reasons that everyone gets into trading, right? I had an interest. I like the flashing numbers, the bright lights, the math. I love the idea of making money from home or from a remote office and not having to go in the field or deal with clients or do manual labor. And then the thought of running a large shop with a big trading desk, wearing a fancy suit, being with your buddies, making bets more or less, right? It's always attractive. It's super competitive, as I mentioned earlier. And as an ex-athlete, I played baseball and basketball growing up, even in college. So I love to compete. And then obviously the luxuries, right? The material world has a pull on almost everybody, especially when you're younger. So, you know, all the Wall Street guys, you know, with their cars or houses, the yachts. I think that yacht picture is Jim Simons from Renaissance Technology, so I'll be talking about a bit in detail later. So my early trading, I started in grade 5. There was a stock contest. I think I lucked into it. I'm not exactly sure how or what the strategy was at the time, but we did have some success, so that kind of always stuck with me. My first job, actually an internship, was at Del Monte Foods. So I don't know if you guys are familiar, I'm sure, but they're a big food processor. And what I was doing there was around hedging their actual, the actual product that they would buy to create the products that they would then sell in the stores. So I got a firsthand look at kind of the whole hedging process, commercials, how it goes from producer to consumer. Really good insights, especially on the commodity side. But then I left and went to university, where I was on track to go to law school and become a lawyer. And a couple of years in, I just realized that I hated it, absolutely hated it. I wasn't into the idea of reading nonstop. It's much more like to be hands-on. I'm sure as much of you traders are. So I needed a way out, and I had remembered trading. It seemed like something I could do and pick up in between classes, maybe at nights, right? So I got back into trading, and I had taken like the pretty standard, you know, retail trader approach, right? This is the beginning of my journey. I had learned technical analysis, maybe every indicator, you know, known. I tried to create some of my own using Excel. I was trading low floats, you know, penny stocks, you know, this week's option expiration, really high risk stuff. Like, you know, looking back, I was, you know, looking to make a little bit of money into a lot of money, right? Like every beginner trader is. I was working on, you know, psychology. I'm reading Mark Douglas's books and everything, like, you know, along those lines, trying to master patience and discipline. And I'm eventually, you know, really getting a good grasp on it. Things are starting to click. The account's starting to grow. It's not without its setbacks, but I was finally had some success and something sustainable, I thought, which had brought on a new lifestyle, right? I was young in university, making more money than, you know, some of my classmates' parents, right? So I was, you know, we were going to clubs and going to sporting events and doing the fanciest restaurants. And I had dropped out of law school. I was essentially a dumb kid with some money, right? You know, and you could see the little arrow, right? That's my account was going that way. And eventually, like every story, right, it ends at rock bottom, right? I don't remember exactly the first trade that started the spiral, but I do know there was a biotech company that I had gone in way too large, had failed a test, and you know, basically that put me on an even worse spiral down to basically, you know, I didn't have an account anymore. It had cost me like my girlfriend, and you know, I had to move back home. So I was like back in the lab, right, back in the bat cave, the cave. I was in a do or die situation because I had just dropped out of school. It was really just me, and I had no way out. I had to like drill down and kind of figure out trading from the ground up for the first time, right? So I was 4 or 5 years in, and I was like, okay, I need to get a mentor, right? I need to find a job in the industry where I can learn and take what I've already learned, but just like perfect it. I thought that was the missing piece at the time. So I was lucky enough to take an assistant job to the owner. So I was basically, you know, the executive assistant to the owner, who was just an absolute legend. I could not have gotten luckier in life than taking this ground level job where I'm working directly with and for the owner. So he's a unicorn, and I say that because he did everything at the firm, from building the strategies, coding the infrastructure, coding the front end where we're viewing the strategies. You know, he's configuring the hardware, everything. You know, he's paying the bills, you know, doing the accounting, right? Like he just everything. And he had all the toys, right? He had the cars, the nice house. And he was such an innovator that when he had left to go on his own, the brokers would actually come down to where we were at in South Florida, and they would take us out to like the most extravagant dinners and, you know, tell us stories about when he had started out, and how they had actually changed their business from, you know, floor traders at the CME to like the electronic traders, which he was, to try to accommodate him. And like, basically I wasn't doing anything at the firm for the first, you know, for a good while. I'm basically like getting his laundry, you know, coffee, getting his lunch, keeping him, you know, company in the office. I'm doing some spreadsheets, like some, you know, analytics that he would ask me to do. And I don't know if you guys know Liar's Poker, Michael Lewis, who wrote Flash Boys and The Big Short and all that. He also, I think his first book is Liar's Poker, but basically it's a game where the serial numbers on the dollar bill are your poker hand, and you go around the table trying to bluff each other. And instead of us playing with real dollar bills, he instructed me to build a program to generate, you know, artificial synthetic serial numbers so we could all play at lunch every day. So that was like my big contribution to the firm in the beginning. And then he'd go on these extravagant vacations or whatever, and I'd sit there and monitor the P&L. And then eventually I got to do some manual hedging, where I'm basically watching his algorithms, and then I'm just manually hedging them whenever I feel, you know, feel something, right? And I think he just allowed me to do that to kind of just keep me happy and keep me at the firm, because I really wasn't making anything. I've lost kind of my original motivation. I wanted to be a trader, not really have like a job, right? So I'd gone to him and I was like, hey, like I want to contribute. And he's like, yeah, sure. Like everything we do here is automated, right? Like there's no, you know, charts, right? Like there's no technical analysis. There's no, you know, psychology, right? We're completely systematic and mechanical, which is way different than what I was doing. And he's like, you know, there's tons of data, like a terabyte a day. And I'm like, yeah, cool. And he's like, no, it's too much for Excel. Like you need to learn how to program and write some code. Like, you know, what are you going to do? So basically the next day I showed up and I had this exact stack of books on my desk. And then you can see, like I said, I had lost my girlfriend. I had to move into a single bedroom apartment. Really just rock bottom, like starting over. I'm just reading like ferociously. I'm trying to study, learn to program, learn trading, learn data, statistics, just going down this whole path that was so different than what I thought trading was. So, you know, just to refresh this in case anyone is new to systematic trading, it's basically a rules-driven approach that's rooted in data. You can think of it as like an if-then. So if X happens, then my system or I do Y. It's not very different than normal trading. It's just that it's supposed to be emotionless and completely predetermined. Like for instance, if you knew a coin was rigged, right, would it change how you bet? Surely, right? So how do you know it's rigged? You have to collect some data on its past flips, right? Like if you flipped it and you saw that 70% of the time was coming up heads, well, you know, surely you wouldn't take the same risk betting on, you know, tails as you would betting on heads. Same thing with blackjack. I don't know if you guys are familiar with Ed Thorpe and Beat the Dealer and then Beat the Market, 2 books he wrote. But essentially like card counters in casinos, right? They were getting an edge on the casino by understanding when the deck was hot, when it was more likely, less likely to display certain cards, and then that would change if they bet or how much they bet. And I think those are really good I'm losing the word, but those are really good metaphors for what systematic trading is. So then I'm starting to think like, okay, this is how this guy is able to go on vacation all the time, right? Like he knows when the deck is hot and his systems are going to act. And then when the deck is cooler, he's not going to be taking as much risk. And he doesn't mind checking out, flying off, and remotely monitoring his algorithms, right? Like it's starting to click. And then one random lunch, you know, he says to me, I think we're the only two, and he's like kind of getting on me about my manual approach to trading. And he's going through, explaining to me how hard manual trading is. And he shows me like a series of 5 illusions like this I only remember this one. I think there was like another one that was like a young lady and an old lady, you know, and you know, like, what do you see? Like, do you see the duck or the rabbit? And like, you know, I don't know if you can see my mouse, but the duck's bill, his mouth is on the left-hand side, you know, and then the back of his head is on the right. And then the rabbit, right, his nose is on the right-hand side, and then the duck's bill actually turns into the rabbit's ears. So in case you're struggling to see that, I hope that helps. But I realized whatever I would have told him, he could have said the opposite. So if I said I saw a duck, he saw a rabbit, right? And if I saw the rabbit, he saw the duck. And we go through this series of like 5 illusions. He's like, how is this different than a chart, right? He's like, if you're looking at a chart, I may see a double bottom and you may see a bear flag, right? One of them is very bullish or perceived to be, and one of them is bearish, right? So, and then he's explaining to me this apophenia, and I don't know that either of us is pronouncing it correctly, but you can look it up, the link's there. Basically, in our DNA as humans, we're pre-programmed to try to spot patterns. It's part of like our survival instinct, because if we notice something repeatedly, it should like trigger something for us to pay attention to it. So we often see patterns when there is none, right? Like, I don't know if you guys have seen like, you know, people will toast bread and they'll see like, you know, religious figures or whatever, you know, political figures in their bread. And that's all part of this. So again, there's plenty of other issues that, and I'm not saying that manual trading can't work. I'm just saying these were the things my mentor pointed out to me and the struggles that I've had throughout my life. Like, I'm just one of those people that can't make it work. And when he started explaining these things, it's like, yeah, like maybe I'm just not interpreting things the way that the winning manual traders are. It was just a cold reality. But at that point, I was at the ground floor, so I needed something. And again, like, he's showing that, you know, like if you use a linear scale or a log scale, again, that's going to change, you know, I'm just going to move, sorry, because I'm going to have to play the video. Okay. So again, like if you use a log scale or a linear scale to plot your charts, it can completely change where you draw your lines, your support and resistance, your demand zones, whatever it is, your trading patterns. And that ultimately changes where you put on or take off risk. And then again, like even with the log scale, you can see a little bit better. You know, do you use the lows, the wicks, or do you use the body? Like, that changes drastically where you would buy, you know, support. So there's just too many ways to go wrong in my mind with manual trading. We really had to like break those down for me to be a contributing factor to the firm. And then I found, you know, years later, this Jim Simons clip, who's the greatest trader of all time. He built Renaissance Technologies, which their medallion fund has returned 66.1% compounding over the last like 30 years, which I think after their ridiculously high fees comes out to like 39.1%. And he has this great clip. I'm going to play it. I'm not sure. Let's see. I don't know if you guys are going to get the audio, but it starts at 36. Here we go. Oh, sorry.
So Dave, I can't see or hear anything. I don't know if it's the same for the audience.
Okay, it's not playing. Okay.
I can't see or hear. I only see the PowerPoint.
Okay. Well, the basis of we could skip it. I can send a link or something. It's this known YouTube video. You can start it at 36 minutes and 48 seconds, and then play it till 38 if you want to do it on your own. But basically, Jim Simons talks about you need to be 100% model driven, because if somebody walks into the office and says, "Hey, we own too much of a stock. I think we should sell it," there's really no way to run a business that way, because even if you do have too much of that stock, you can't go back and simulate how that guy felt on all those past days. Like, why does he feel this way today? Maybe he had something personal going on, whatever the reasons are. You can't run a large trading business based on feeling or emotion. It has to be something you can simulate. And again, these are not my words. This is Simon's. And my mentor is basically preaching this to me. So I'm at this kind of like, epiphany moment where I realize like manual trading, I'm not having success with it. Let me try to go back. Okay, so so if we know we need to be systematic, the first thing we need to do is back test, right? That's the first part of like essentially being a systematic trader. So really all back testing is testing your ideas on historical data to see how they would have done, like Simon's talked about, simulating your model on past data. Now this can be done manual, right, by like scrolling back on a chart and seeing how it's done, or it could be automated with code. And obviously there's more pros than cons to the automated approach when you're dealing with large sets of data. So anyways, okay, back to my trading journey, my story. So this is like, months later. Let's fast forward a little bit. I can code. I'm back testing. I've read like all the books every week. He's like, hey, here's the new stack of books, right? I'm just plowing through everything he can kind of throw at me. And I go to him and I'm like, hey, like, give me a piece, like, give me some knowledge that I can go and test. Like, I want to like see what's working. Like, everything I'm testing is terrible. Like, I want out of this like 1-bedroom apartment with like the paper on the window and like the leaking door seal and things like that. And he's like, yeah, right. Like, I'm not giving you like a strategy. You know what I mean? Like, you just start with what you know and just work from there. So that's what I did, right? Like, you start quantifying your ideas and you start very simply at first. And like the first thing we're taught as traders, right? And like you hear it all the time, like price pays, right? Like price action is the be all end all, like price pays. So I'm like, okay. So in code, like the typical way to quantify these ideas is that the current bar is always considered like 0, right? Like it's happening right now, and then 1 bar ago is 1, and 2 bars ago is 2, and 3 bars ago is 3. So like, okay, the first thing I test is like, what about if the current bar is above the bar 5 bars, right? And then you can do, like get more advanced and say like, okay, what if the close is below yesterday's low, right? Like that's maybe significant selling, right? Like we're taught all these things in textbooks, right? And like, just to like give a couple more ideas about how to like quantify price action, right? Like an inside bar, it's very simple, right? It's just 2 things, right? The high has to be less than or equal to the previous high, and then the low has to be greater than or equal to the previous low. And then you can expand from there, right? Like an outside bar, you would just flip the operators and you have an outside bar. So at that point, like I was off to the races. And I'm like, okay, what are the foundational level stuff that like you hear on, in every textbook, everything I've read, every website, every chat room, every YouTube video, like what are the foundational things? Let's start coding and testing from there. And then I should be able to like build up off the foundation to build something really beautiful. So like the foundational things are, overnight trading is risky, right? Like if you don't have to hold the risk, like then don't, right? And your time in the market is just more time at risk. The other thing that was like foundational to me at that time was like moving averages defined regimes, like bull and bear, right? Like above the moving average was a green light, like risk on, and below the moving average it was like, hey, hold on, like, maybe like the market's unhealthy. And then obviously like all the candlestick patterns basically come pre-labeled, right? There's like the bullish hammer or like the bearish engulfing bar, right? Like, so these are like all the foundational level things that I started with like after I had taught myself to program and wanted to build trading systems. So I took these trading truths, this foundational level stuff, and I'm like starting to test it. And the first thing I test is that the overnight is risky. And it turns out that the S&P 500 futures over like the last 20 years return 3 times as much overnight than they do during the US hours. And the same is true for the SPY, the SPDR ETF, which is, I just show this graph on the right, and obviously there's some execution nuances that are left out of both these graphs, but the general idea is that the first foundation that I thought that the overnight was risky is now showing me that, at least in the primary markets we were trading, that the overnight was a better source of returns than the day session. So I'm like, okay, now I have to test this on the other symbols, right? And I go and test this on a bunch of other ETFs, and I noticed that there's just no consistency, but the overnight wasn't as risky as I thought, right? Like in the NASDAQ ETF, the overnight, the orange, is a far and away a winner, right? And like silver, very much a winner, but bonds, TLT and IEF, the blue, the US session was much greater. So again, like this trading truth is completely destroyed for me. So I'm like, okay, like let's just move on. Let me go to moving averages. Maybe I can start there. So I test moving averages, and I test like every possible parameter setting. And the one that stuck out the most was, and I did this like 6-7 years ago, so I think it's somewhere here in the graph, is above and below the 8-period moving average. And this is again for the S&P 500 because that was our primary instrument. Is if you were to buy, so like if the day closes below the 8-period moving average, you buy, and then you sell the next day and then reevaluate, you would get the returns on the left here, the below graph. And then on the right, you would get this graph, which at the time of running this, like it was like somewhere here, like, which is a negative return. So it's like, again, I'm like, this trading truth is just completely destroyed. Like I can no longer rely on this. And then I'm like, okay, let's test it on more symbols, right? Like maybe it's just an S&P anomaly. And sure enough, like green is below in these graphs and blue is above. I'm noticing that on most symbols, being below the moving average actually was a greater source of returns, at least historically, than it was when you're above. And again, this is different for all symbols. It's different for all parameter settings. So like this is just the 8-period moving average, and maybe it's completely opposite for the 50 or the 65 or the 200 or whatever it is. And at this point, I'm like, okay, so the 2 foundation level truths that I thought are just completely like destroyed. I can't use them the way that I thought. Like they need to be market or parameter or whatever specific to work, and like that's just not going to cut it. So I'm like, okay, candlesticks can be my saving grace. Let's go to trading truth number 3. And I like finally got to like the bearish engulfing candle. I think this was like the final straw. In every textbook, every resource, right? I pulled these images from the internet. And if you don't know what a bearish engulfing is, it's basically a red bar that closes lower than the open, that the range of the red bar completely engulfs the previous bar. So you can see like the high is above the previous high, the low is below the previous low, and then there's a couple other wrinkles like the close is below the low or the close is below the body, or you can experiment with that. But I just did the range itself in my test, and like the test has shown me that these down arrows, like it's assumed in all the trading textbooks that this is like a negative sign, and the next day after a bearish engulfing is higher almost 64% of the time. So like at this point, I'm like, okay, everything I thought that like I was using and having success with early on before I hit rock bottom, I'm like all these foundations, all these trading truths are like, it seems like lies, right? And at that point, like I come back in the office and I just feel like Neo in the Matrix, like in the construct where it's the white room and I have to rebuild from scratch. Like I basically know nothing. And the problem when I'm going through this like process of testing everything is that my list of things I want to test just continues to grow. So like I'm still reading every trading book I can get. I want to test more candlesticks. I want to test more parameters, more indicators, right? More times of the day. Like the list is just growing and growing and growing. But like, I can't go into the office and like risk any more money, right? Because I just like kind of proved to myself like these things shouldn't work, and that's why they're not. Like, I'm not trying to get fired, right? Like, I'm trying to improve my income and contribute. So like, things that I thought were checked off and were foundational, like, worked. And that was the biggest eye opener to learning the program and shifting to the systematic approach. So at this point, I had this long list of things to test, and I have nothing around me. I'm just like in this white room. And I'm like, man, I need software that can just test all of these ideas for me, like, very quickly and fill up my room so I can go back like to work and be productive. And that's really what spawned Build Alpha, which is the trading software that I built. So meet Build Alpha, right? This is will be the next version, but the previous versions look very similar. What it is it's a software program that allows you to input tons of trading signals and test them without having to write any code. So I basically code up this big program so I can use it for the rest of my life, right? Like, I'm constantly adding to it. But basically, the backbone of it is a genetic algorithm, which is really, really good for taking large like search spaces and then intelligently finding where the hotspots are in that search space. So I'm basically intelligently reducing the search space to where it's most optimal, right? Like where the good edges or good strategies live, right? So there's really two ways to use Build Alpha. So the first way is you can test single ideas. So like if I want to know what's the likelihood of a certain candlestick pattern, right? I can just go click on that candlestick pattern, set my stop or whatever my parameters are, and then run that test, right? And then the second way is to use that genetic algorithm where I give Build Alpha thousands of inputs. So, price action patterns, comparing open, high, low, close, candlestick formations, chart patterns. I actually worked with a PhD in geometry to quantify chart patterns so that they have to meet certain, like if this point is down here, then the next point has to happen in so many bars. It has to move so far away from the previous point, and then we can actually, with geometry, connect and draw lines like with a system. And then there's seasonality. There's all the technical indicators. There's volume, volatility. Volume and volatility was one of the big things I was working on early in my career because, right, you could basically have 4 market environments where you have volume and volatility both go up, volume and volatility both go down, and then you could have the 2 mismatches in the other quadrants, right? So you can have, volume goes up, volatility goes down, and then you can also have volume goes down and volatility goes up, right? Maybe I said this backwards, but or the same, but I think you get the idea. Build Alpha also has math operators, range, average true range, quantified market profile, tons of things. And this was just like price action, right? Like when I first built Build Alpha, there was maybe 1,000, indicators. I think now there's close to 6,000 because as the years went on, I realized that price alone wasn't enough to give trading systems the context that they need to understand the market environment, right? So the market environment is, we can use a ton of other things, right? Like sentiment, market breadth, term structure, treasury yields and spreads, right? Obviously very fitting today with the Fed announcement of another hike, the US Fed. Option flows like gamma exposure, IV rank, the pricing of a certain risk reversal, things that kind of give you a sense of how market makers are positioned in the market, dark pool index, alternative data, right? Like you can import things like Google search trends or whatever it is you think gives sorry guys. And then whatever you're getting from there, alternative data, economic data. So like, is GDP going up? Is GDP going down? Holiday data, like does the market trade differently around holidays? And then you have one picture here that's really great I want to show is the VIX term structure. So the VIX futures, right, they expired, every month, let's say, and you can look at how the VIX is priced across the different expirations. is what I mean by the term structure. So is volatility being priced more expensively today than in 6 months, right? And typically, since volatility, grows with the square root of time, you expect volatility in the future to be greater just because of the time component than volatility today. But when the market inverses, volatility inverses or becomes backwardated, you could see what that does to the S&P 500 return. So in this graph, as you move left on it to where the dots are more distributed, the VIX is more backwards, let's say. And as the VIX is more in line, you know what more to expect. The market is better behaved. You know what more to expect, so to speak, from the market on a given day. So obviously these are huge things to add to trading systems to give them, hey, what market are we in, right? Like, are we in an inflationary environment? Are rates rising? Are rates coming down? Trading a market in 2017 is very different than this past year, right? So any way that we can add the trading system to kind of convey that is obviously helpful. So how do you find trading strategy ideas, right? Screen time, trading books, trading papers, technical indicators, alternative data, or you can use a genetic algorithm or a machine learning approach basically to help you take your inputs and find it for you, right? And we've kind of gone over some of this bottom list, so I'll just gloss over it, right? Like things you could put in to these, multiple time frames, intermarket relationships, correlations, relative value, seasonality, time windows. So basically, where do you start, right, with Build Alpha? And like the simplest way, and I have a good friend that's a big seasonal trader, but seasonal trading is very simple. It was where I started, more or less. And I know like some with the stats background are going to be like, hey, why? The sample size is there for seasonal stuff. Like why do you trade it? So we'll just gloss over that. It's a topic for later. But basically seasonals include like day of the week, time of the day, time windows, day of the month, right? Trading days left in the month, what time of the year, right? Like we've all heard sell in May, go away, right? So these are like very simple, very robust, and they're explainable. And I had this big fear of building trading strategies, showing them to my mentor, and then like, hey, it lost money or it didn't perform like how we expected. And he's like, what was the trading system doing, right? Like, and I'm like, well, I don't know, right? Like, I can't justify that and keep my job, right? So I needed something that I could explain at the time, and it was also easier for me to trust the automation if I could understand the system, right? So these are two systems that are pictured that we'll actually build momentarily in Build Alpha, but I'm just showing you. I think I published them on third-party sources in like 2017. So they've had a public since then. There's tons of guys that have been trading them. So we'll get into them in a future slide. But obviously we want like more complex than just seasonals, right? Like even though there's textbooks like Calendar Anomalies is a great textbook that explains seasonal stuff. We need to fight like today's battle, right? And I know these funds are using the most complex, the most computational power possible. So I can't sit there and just like go with my simple ideas, right? I need something that's going to automatically generate strategies. And that's like really what Build Alpha does. And people are like, we all follow the same process, whether it's manual or automated, where you test an idea, let's say it fails or doesn't do as well. You make a tweak, you add a filter, right? And then you have that hope to like, yes, I've just cracked it. I'm going to go back and trade this tomorrow or next week or whatever it is. And then you test that idea, live, or, you go back and scroll back on some charts or whatever. And that idea fails. You make a tweak, you add some filter, right? And you just do this process over and over and over. And it's just like you either run out of time or you run out of money, and you're just this snail doing it like this manual way, where Build Alpha is like this, right? It's like a fighter jet, right? Like it's going to test these thousands of strategies in a second, and leverage like today's modern technology to find trading strategies. And like there's a saying, and I don't know how it's taken across the world, but it's very popular in the US, like don't bring a knife to a gunfight, right? Like every victor in war, right, has really struggled with, you know, the aggressor or, you know, their counterpart that had the greater technology. So it's like, who do I want to be in this fight, right? It's like, do I want to be the snail, or do I want to be, you know, the fighter jet, so to speak? So if we're using automatic signal generation, the computer is going to find things that maybe I can't explain. And that goes back to like my fear. Like my foundations are broken, so I have nothing to go off of. But I can't necessarily explain something like nonsensical, like why did this use this signal and this pattern, and, or like in this indicator and this combination to create a trading system. And I found these Jim Simons quotes in in the latest book, and I think that they explain it so much better than I can. The book is The Man Who Solved the Markets. I think it was released in 2018 by Gregory Zuckerman. I highly recommend it read. It's very light. But these quotes, like I won't read them all, but basically, Simons and his researchers didn't believe in spending much time proposing and testing their own intuitive trade ideas. They let the data point them to the anomaly signaling opportunity. They also didn't think it made sense to worry about why the phenomenon existed. All that mattered is that they basically traded enough to ensure that they weren't statistical flukes. Second quote, right? They really didn't care. Simons and his colleagues hadn't spent too much time wondering why their growing collection of algorithms predicted prices so precisely. They were scientists and mathematicians, not analysts or economists. If certain signals produced results that were statistically significant, that was enough to include them in the trading model. And like here's a really simple quote: I don't know why the planets orbit the sun, but that doesn't mean I can't predict them, right? So we don't have to know why something happens, why price moves, but if we can predict it with significant sample size, right, then that should be enough for us if it's enough for the greatest fund of all time, right? So basically more than half of the trading signal Simons team were discovering were non-intuitive, or they couldn't fully understand. Most quant firms ignore signals that they can't develop a reasonable hypothesis to explain them, but Simons and his colleagues never liked spending too much time searching for the causes of market phenomena. So again, they're basically, and then he gives one example in the book. There's very few specifics given in the book, but he says volume divided by price change 3 days earlier, yes, we'd include that, right? So there's no reason that volume divided by the price change 3 days ago should make any sense. But that was something that they were willing to include in their process, right, their system. So, okay, so now I'm at this point in my journey where it's like, okay, we have all these different things. I got computing power to crunch them all, but how do I prove that they're statistical flukes, or if I can have confidence to automate them, right, and trade them? So how do we arrive at statistical significance? So there's a ton of robustness and stress tests that I put in to build alpha that I've been using for years, that are like, in my mind now, right, the trading standard. Like if you look at a trading system, you don't use these tests, like I can't imagine a world where I would feel comfortable doing that now. And like, so the simplest one is enough trades, right? So enough trades, right? On the left, I feel like I'm pressing the time, so I'm going to try to speed through these, but enough trades. So I did a Python simulation, 30 coin flips on the far left, 6 different tests. And you can see that in the top left, we got 20 heads out of the 30 flips. But in the lower right, we only got 13 heads, right? So sometimes we get a lot of heads, sometimes we get a lot of tails. We know this is a fair coin. We should be 50-50, but in 30 trades, 30 flips, we're not seeing 50-50. 100, I reran the same simulation, 100 trials. You can see we're getting closer to that 50-50, but we're still not there. And then obviously I just reran it on a much larger sample, like 10,000 trades. And you can see that right there, right? Like it's 50-50 like every time. So if we get enough trades, right, like that's the simplest way we can say that we have a little more reliability in the trading signal, the trading system. Then Build Alpha has a lot of robustness tests that focus around overfitting or curve fitting. So real briefly, if you're not familiar with the term, I try to write about it extensively, but basically if you're overfit, you have like too many specific rules to like sidestep specific market risks or things in the data, right? So like, okay, I add this rule to sidestep 2008. I add this rule to sidestep the COVID, crisis. I add this rule to sidestep the 2022 crisis. And now my trading system's perfect, right? It's like, okay, well, that's overfitting, right? Like we're trying to avoid that, right? We don't want to see a pattern where maybe there's not, or we don't want to have 1,000 rules to make 100 trades, right? Like that's not going to work. So Build Alpha has all these other tests. I'm going to kind of skip over them. Audit sample testing real quick. You split your data, you build your strategy on the first part of the data, and then it's never seen the second part of the data. And then if you test the strategy on the second part of the data and it does well, it's like simulating that strategy seeing like unseen live data, right? Versus random. So what you could do is you could randomly build trading strategies. The best possible random trading strategy is like your benchmark. And then if you can build a strategy with software that beats that random benchmark, then you know that there's something real about your strategy that the computer couldn't find, at random, right? It's not found by pure luck, right? There's some actual edge in what you found. And then versus others, right? You could test your strategy on other markets, right? That's always a good sign if the strategy generalizes well to other markets. And then the noise test is really one of my favorites. What this does is it takes the historical data and it adds random amounts or subtracts random amounts of noise to all the historical data. So we basically recreate 1,000 alternate universes where the noise is different in the data. And then we retrade the strategy, and that's actually what you're looking at in this graph. And the idea is if we change the noise, the volatility in the data, and the strategy, all the performance falls off a cliff, we obviously fit to the noise of the specific data set that we built the strategy on. But if the strategy performs well or within reason on the noise adjusted data, then we have like this additional confidence that kind of however the market's noise adjusts in the future, as long as the underlying signal is present, we should be confident in our trading system. Then obviously there's all the Monte Carlo analysis, and I have 5 or 6 different variations included in the software, and they all have kind of different intents and purposes. But I just didn't want to leave them out. But basically these tests, kind of give me that, it removes that fear of automation of when I can't explain the trading system, right? And I can go to my boss and go, hey, like this is potentially statistically significant. It's passed these tests, right? And really, I have like a funny story with the variance test. Like if you look at these two tests, right, the black line in both of these is the same thing, right? It's the same back test, or they're very close, right? It's not the same strategy, but it's the same results. Like in the same amount of trades, they made the same amount of money, more or less, right? But it's very easy which distribution, if I simulate these trading systems forward the same, 350 trades or whatever, one of them was very lucky, right? The one on the right was very lucky. It performed at the top of the distribution. And the other one performed in the middle of the distribution. So if you were to get one of these alternate realities going forward, and you could only choose one, it's obvious which one you would choose, right? Like you want the one on the left where the worst case scenario still gets you above zero, right? Above break even. Whereas like, in the other scenario, some of the worst ones are negative, like they're big losers. So like the first trading strategy I thought that I had built, I brought to my boss, sent it to him, walk in his office. I'm like, hey, like, I think I got something, check it out. And he runs, he had like 6 monitors, right? Like, like all the charts and displays, flashing numbers, watching all of our algorithms. Then he has one laptop that he writes code on, and he punches in the test, flips the laptop around, and it's basically a distribution like this one on the right. And like, I really don't say anything. Like, I just know to like put my head down and go back to my desk. And like, so he like tested my stuff in like 2 seconds, and I was like, okay, I'm getting there, but I'm not there yet. And then like, obviously he explained all these validation tests, and like the importance of statistical significance. But okay, so that's it for like how I got to Build Alpha, right? I need to rebuild my white construct, my white room with new ideas. I need a computer system to crunch all these numbers very fast. And then I need validation tests to kind of rule out the statistical flukes, so I have confidence if something maybe is a little nonsensical. So now I'm going to see if I can pull up Build Alpha. I think, could you give me a heads up if you guys can see this?
Right now, I can only see the slide saying euro dollar.
Okay, let me see. I'll try to get out of the slideshow. Okay, how about now?
Yeah, here we go. We can see. Now we can see it. Yes.
All right. So I have to look at another screen, guys, so I'm not going to be looking at the camera. I don't even know if I have been. So first thing we do is build an intraday strategy on the euro US dollar that I gave away in 2017, I believe. So
David, can you maximize it a little bit? Is it possible to make it a little bit bigger? I don't know if it helps, but just to make it more easy to see what's going on.
No, I don't think, but the graphs will be large.
Okay.
So the first thing I'm going to do is I'm just going to import some intraday data just so you guys can get a sense of that. So I already have it in, but basically you just go to add files, you add your file, and then you can give it the symbol, the time frame, the contract. It's a futures, so it has a contract multiplier over a point value, and then the margin, and then obviously the currency and the type of asset it is. So it could be futures, ETF, stock, crypto, alternative data, it doesn't matter. So I just come in here, I'm going to select this data. I'm going to put it it's a short system. It only trades at the end of the week, although it works pretty much throughout the week, but the original publication just had those. And then I'm going to come into time, and I'm going to add a time signal. So I can set the different time windows I want to trade. This one trades at 5, but you can see like I could set 10 a.m. To 12, right? I can test anything without having to write any code, right? So, and then this one just holds for 3 hours, but since I imported 15-minute data, right? So that's just 12 3-hour bars. And then I just hit simulate, and it's going to go ahead and generate this. I hope it doesn't generate on a different screen. So it's reading, 15 years. Oh, there it is. So it's reading 15 years of the 15-minute data, running the test, and then you can see, I left out a 0. So it's hour, minute, second. I just left the 0 out. So those, ignore those results. It wasn't catching the time window, which is the whole premise of the trade. So now I'll pull this up. So I'm looking for the time, the combined results, and then you can see, I want to go to my primary monitor. This webinar software is using a different monitor. Apologize about that. But basically, you can see the strategy. We can check it by date, right? So like 2017, getting a little parabolic here, but nonetheless, I think that's obviously with the euro's decline makes sense, right? But anyways, very quick, very simple to build a strategy. The next one I want to build is called Turnaround Tuesday. It works in the S&P 500. I think I originally published this one a year before in 2016. So I'm just going to clear it. So I clear all the signals, right? I'm going to clear the data. This is a long strategy. So I'm just going to go to the S&P 500 E-mini, and I'm going to go to, it's Monday, right? All signals are evaluated on Monday. And then I'm going to go to close. Close is less than the open. I just check that one. And then I'm going to set it to a 1-day hold, right? I'm using the daily data. And then I'm just going to go ahead and simulate. And I'm going to pull that up. And you can see the combined results right there's the close less than the open, and the day of the week is Monday. Then if you were to buy basically Tuesday's open, hold to the next day, this is your performance, again, seasonal. So, okay, really, really cool feature about Build Alpha, and this is a big time saver, and something I needed is I'm going to go in here and just make sure that I can allow three rules per strategy, and you can control that. You can even up it. And then I'm going to come in here and right-click, go to rerun the strategy with adjustments. And now what I can do is I can click all of the rules in Build Alpha. I can require the 2 for the original rules from the Turnaround Tuesday. I'm just going to turn off. I have some custom signals. I'm going to turn those off. Okay, so I just turn those off, and then I'm going to go ahead and just hit simulate. And now Build Alpha, you can see, is going to test the 5,000 some signals it had. Super fast. There's my results. And then I can just go here and sort by P&L to drawdown ratio. And you can see the original results had a 10, and now Build Alpha found me one that had a 25, right? So obviously, like, there's some testing things that we skipped over, right? We didn't use any auto sample and things like that, but I'm just trying to quickly show you guys the software before I run out of time here. But so now we've improved the software the trading system very quickly. Build Alpha has one other really, really cool feature that I want to show you guys. Now I can take that improved strategy and I can do what's called an intraday edge test. So intraday edge shows, this is it. It basically takes a daily strategy and it knows that you're going to hold for the entire day or longer, right? That's this big green bar. And it says, okay, well, can I capture most of that edge inside a small time window of that day? Like, maybe I don't need to hold for the whole US close. Maybe I don't need to hold for the entire US session. So what it does, and I'll just go back and show you guys, is you just, actually don't right click, you go to test settings. I just picked 60-minute data from here, which I've imported earlier. And then I can just hit OK. And then I go to this intraday edge test, and you'll see it's running. It'll tell me when it stopped. And what it's doing is it's searching all the intraday windows to see if it can improve that trading strategy by just holding for a smaller amount of time during the day. So you can see in this example, so the combined results, you can see I've even improved it more. And now instead of holding it for the whole 24 hours or 23 hours that futures are open, I'm holding it just for the 18 hours that this is telling me. And it shows me all the other variations. It tells me to enter at, the time of the intraday data, right? And it's, we've improved the winning percentage, we've cut the drawdown, we've improved the P&L, right? So it's a very quick test to basically take daily systems and see if there's a little more efficiency to be had by going to an intraday system from it. So I kind of call it building intraday systems from, reverse, right? Like, most people start with the intraday data, but the intraday data is very noisy. It's very difficult. You're competing with guys like my unicorn boss, right? So if you can start with a daily strategy that works and then go to an intraday, right? It's just like a different approach that other traders aren't doing. Obviously, with Build Alpha, I showed in the first example, you can build from intraday data from the beginning. But just wanted to show that. So I think that's really it. I just Build Alpha, guys, just to give you an overview. The lifetime access, normally $3,000. That's gonna go up with the new update. I have a system trader training course that comes with the software. It's like 50+ videos. They're all labeled about one feature of the software. There's a written user guide. I sell that separately. You can include that. I have a 10 strategy starter pack that you can import into Build Alpha and start building off of things that, kind of like I just showed. You'll have full access in the new version to the 1-minute database. And then you also will get a strategy checklist that shows like the 10 things that I think must be true for a trading strategy to go live. So like, it's kind of like that 2-second test that I showed that previous example with. I have a series of those that every strategy must pass. So like, if you add it all up, right, it's $6,000, make it back in a couple trades, right? Like, that's the idea. But I know that's unrealistic for a lot of traders. That's the value I put on it. They're sold separately. You guys, as part of this community, and I really appreciate the opportunity to show my story, the software, and kind of where it's going. I would be willing to do the lifetime license for $1,295, and that includes everything that I mentioned. Obviously, I have a special link. If you go to buildalpha.com/daytraderdk, you'll see pictures of the new version of the software, kind of some of the new things you can do. And then obviously you'll see the strategies, you'll see the everything that's included, and then a way that you can go forward. So there's the one-time payment, or if you wish to do a monthly option that just would pay monthly continuously, that exists as well. There's a sign-up fee. I have to cover some costs, but those are two options, the best I can do for you guys. But I really, really hope and want to stress the need to put data behind your trading. If you want to treat it like Simon says, I wish we could have watched the clip, but the best way to run trading like a business is to have something you can simulate and build expectations around. Where am I going to be in 100 trades, or am I going to be in 300 trades? Is this system better than this system, right? We all have limited capital. So how do I allocate to this strategy or this symbol or that symbol? So you need some data to kind of rank those things and put you in the best position for success. And that's really what the data is there for, from my experience. So that's all I have. I hope it was helpful. And obviously reach out, guys, david@buildalpha.com. I don't know if you guys have questions or if I should be checking a chat, but
yeah, I can check it for you. But David, maybe I think you should mention that you're actually including 10 strategies in this pack. Also, the ones the two ones you showed. Could you say a little bit more about that?
Yeah. So the strategies are they're robust ideas that you can use. You can easily understand. You can easily build and rebuild with Build Alpha. They're meant to be starting blocks. They are not meant to be like your retirement account, like close your eyes and go trade them. I would never advocate for something like that. But yes, they are building blocks. They are useful. Some of them have been out of sample for years. Some of them have not been released, so you guys are the first to see them. And obviously, they're all compatible with Build Alpha, so you have no problem kind of using the feature set that I showed you to kind of tweak them, test them, try them on different time frames, markets, dates. But yes, they are most certainly included. And you'll get like a PDF write-up, right, that will explain the rules, the entries, the exits, the dates they were tested on, the equity curve, the portfolio of the 10. You'll see what that looks like. And then you'll get a file that you can import into Build Alpha to view them.
Okay, I want to take just the last few questions here. So Jacob is asking, like, if you could tell, just to give an idea about what actually works for you these days. Like the market this year has been a very, like I would say, almost weird market, very unusual market. What is working for you these days, just in general terms?
Yeah, definitely a weird market. But again, I think that those non-price-based signals are so paramount to include in your research, because the market, the farther back you can go, the more data you can collect, the different market environments you can test on is only going to make your strategies more resilient, right? You don't want a strategy that was just built for one bull market, right? Like, and I think that a lot of traders are falling into that trap of maybe I never saw charts that look this way, so I never built logic into my strategy that accounts for something like this year. But as system traders, right, we're ingrained that more data is better, more diverse data is better. Like, does that make you perfect? No, right? Like, we're just trying to shift the probabilities in our favor, right? We want to be in that distribution where the worst case scenario, hopefully is still positive. But I don't want to push like another blog because it's written on another site. But I did show that one earlier clip. I don't know if I'm still screen sharing. But like, things like this where you can identify, maybe the market has changed, right? Like that should guide your, all your strategies, right? Like maybe it should turn certain strategies off. Maybe it should lower the risk on other strategies. Maybe it should turn other strategies on that are hedging strategies, right? Like, so there's a lot of things that maybe are firing in 2022 that weren't firing in 2017 or 2019, right? And I think that is what's different about this year than other years. But as a strategy developer, a trading system developer, we have to anticipate the market's going to be different. we need to build for that environment.
Okay, Klaus is asking if you would recommend Build Alpha for someone who is completely new to trading, like rookie level.
So I mean, I'm biased, yes. I think like the closer you are to this, the better, right? Because there's less to unlearn to then relearn, right? Like the human has all these biases, like like the foundations that I thought I had and that I was trading and risking on turned out to maybe be useless or polar opposite. So I think that if you have a green slate or this white construct, you can build a foundation that is rooted in data from the beginning. So yeah, absolutely.
Okay, and then I think I'm going to take the last question because we overstepped time a little bit, but it's by someone called Retired Farmer. He's asking, those 10 strategies, can we import them into MT4 and demo trade them?
Yeah, so in the current version of Build Alpha, there's no live trading, but you can generate code and then import that code into, I'm going to lose the whole list, but TradeStation, NinjaTrader, MultiCharts, MetaTrader 4, MetaTrader 5, Pro Real Time. So you'll be able to demo account them in those platforms. The next version of Build Alpha, which includes is included in the lifetime license, will have the ability to monitor all the strategies you save in Build Alpha in real time. So I have some live data connections coming in the next version that will then just make it easier to do it inside Build Alpha. You'll still be able to generate the code. I'll never take that away, but I'm just trying to move more under one roof, if that makes sense.
Okay, yeah, I'm just going to take a last one because Morten says that the payment link is not working when pushing for the 1295.
I'll have to send you an extra link. Then I'm not sure why that's the case, but I'll.
So, are you going to update it somehow, David, or what? Because I'm going to send out an email in like 10-15 minutes with the link. So, do you think you can update that or just check it?
Absolutely. Yep, I'll do that as soon as we get off. I'll log into to PayPal.
That's great. It's going to take me like 10 minutes to send the email anyway. So, but anyway, if anyone has problem, you know it's going to be fixed quite quickly. So Morten, David will take a look at it. And David, then I'm just going to say this was really interesting. There were a lot of things to unpack, and I'm sure you could have been talking for many hours. But I think the good thing is that I know actually that you're coming back. So maybe you can say a few words about that, because you're coming back in a few weeks with us again.
Absolutely, yeah. So I'd like to go further down the rabbit hole, but I'm not sure everyone's whether you want that or I can go back. So if you guys have suggestions, I'd send them to me, send them directly to you, or whatever would be easiest. But I'm happy to kind of guide the conversation where you guys see best. Truthfully, I'm trying to pay it forward as much as my mentor has to me. So I know what I think may be helpful may not be what's necessary at the different steps in the journey. So I'm open.
Okay, so anyone, if you have comments, then you can write us an email at support@daytrader.dk. We'll take your comments and we'll pass them on to David, and then we'll see how we can shape the next webinar. So I hope you will all do that, so we get a lot of different input on how we can do this next time. And Thomas is saying thank you for a very interesting webinar, and I think this was really interesting, David, and I look very much forward to having you back here again on this series of webinars. It has been really interesting. So thank you very much for being with us tonight, and we'll see you soon again.
Thanks for having me. I really appreciate it. See you guys soon.